Hey, it's Kirkpatrick with Life 180, and today I want to talk to you about the number one reason that I don't like Index Universal Life. Now, if you've been watching my content, you understand that there's a lot of reasons I don't, but this is literally the number one reason, and here it is. If you look at the way that Index Universal Life is structured, if you look at an illustration, my challenge is a lot of the agents don't really understand all the moving parts inside of an Index Universal Life policy. And so what does that mean? That means you're going to have a guaranteed column and you're going to have a non-guaranteed column. They don't understand. A lot of people like to just kind of dismiss the guaranteed column, how important that guaranteed column is, and all the variables that go into what make that guaranteed column. So I want to tell you a story by starting off and showing why I think this is so very important. And to understand that story, let's take a look at the last decade. I mean, think about it this way. We've been living in the greatest bull run as far as the stock market goes that we've ever seen in this country. It should be fantastic. You would think that if an Index Universal Life policy was going to perform at its very, very best, when you look at the upside opportunity, right, with a lot of years earning great returns and then a lot of years not having to take advantage of negative stuff, but just the sky's the limit, internal returns in the policy being great, it would have been this last decade, right? Because I mean, just some great stuff. A couple bad years, but nothing horrible, right? Nothing like earth-shattering since the Great Recession. But here's the deal. Back, if you know my story, I used to be the head of business development for a Fortune 1000 financial company, life insurance company. We focused on Index Universal Life. They were one of the top Index Universal Life carriers in the world. In fact, PHP sells this company that I used to work with. And when I was at that company, I sold a policy in 2011 to a guy. You know, I did it all the right way. I followed everything that the gurus would tell you to do. I read the book, the Tax-Free Retirement by Patrick Kelly, and I did all these different things, and I followed that strategy, and I said, okay, man, this guy, I'm gonna do minimum death benefit, maximum cash value, right up to the MEC limit. I'm gonna do option B, increasing death benefit. We're gonna jam money into this thing. It's gonna be amazing. And then what happened? I built out these illustrations. It looked great. I was new into the business at that point in time. I got excited because I'm like, holy crap, this stuff is amazing. Look what this guy's gonna get for this. Like, how can this go wrong? It's got upside opportunity, it's got downside protection. What could possibly go wrong with this? Well, let me tell you, a decade later now, I actually am good friends with this gentleman. Luckily this has not damaged our relationship. He knows that I've done right by him, and we've done some other things for him since then that have kind of insulated and created a buffer for him, and that's fantastic. But what I will say to this is I want to give some background to the policy that I designed for him above and beyond what I just told you about the minimum death benefit, maximum cash value, that sort of thing. The cap rate when I sold him this policy was 14.5%. One of the top products that the company had for the Index Universal Life chassis, the cap rate was 14.5%. So think about it this way. My conversation with him was like, listen, no matter what the market does, let's take a 20-year look back period and see how it performs. We can illustrate based on that performance and look at this thing. It's going to scream. It's going to be amazing. It's just going to produce such amazing returns. And so on years that the market did 20%, he got 14.5%. On years that it did negative, he got 0. And that seemed like it was going to be great. But here's the deal. Over the past decade, even though we've had the greatest bull run in the history of the stock market in the United States, what we've also had is a low interest rate environment. Now, insurance companies make their money by getting money from fixed market investments, right? So corporate bonds, treasuries, they're really low risk, and they're very into getting secure investments, right? And so, I mean, that's a whole different video on its own. But they're not able to do so right now because the interest rate environment is so low. So what are they having to do? They're having to find returns in other places to sustain the guarantees that they have in their other products, like annuities, like whole life insurance, and making sure that they that when term life insurance policies have to get paid out, that it doesn't hurt the balance sheet too badly. So what are they doing? They're finding other sources of revenue. And what people don't understand when they structure whole life insurance policies and when they look at the non-guaranteed and the guaranteed columns is that the guaranteed columns doesn't only account for poor market performance, it accounts for the fact that they can increase the administration fees, they can increase the insurance charges, but they can also, more importantly, and this is the number one reason I hate them, is they can reduce the cap rate on an annual basis of your policy at their whim, right? So think about it this way. My client, and this is a real life example, a decade ago, had a cap rate of 14.5%. The cap rate in that same policy today is 9.5%. And the consequence of the reduction systematically and gradually over the past decade by 5%, that's a 33%, over a 33% reduction in cap rate in this policy, has actually made it so this policy only has about 38% of the cash value that I thought would be in there, that was illustrated in there with minimum death benefit, maximum cash value. All the while, the stock market has just been booming, right? So the stock market has overperformed what I showed would be there. But the problem is, because they've lowered the cap rates, it hasn't even been close to performing to producing the kind of returns that it said it would do. Why? Because they're reducing the cap rate. So that's a huge impact, because think about it this way. If you have 3 years and you're going 14%, 14%, 14%, that's awesome. But if you have 3 years and it goes 14%, 12%, 11%, 10%, that starts to really dramatically impact the effects. And then you bring into the fact that they're going to increase insurance charges, administration charges, all those things. It has a stupid negative impact on how that policy actually performs. And so one of the things that I'm kind of advocating for right now is just people understanding what they're getting involved with. I mean, heck, I saw an illustration the other day from a person who actually was a WFG agent who sent me their illustration just saying, hey, do you mind taking a look at this and give me some insight as to what you think? And I was like, listen, I can't advise you on your policy, but I can look at it and tell you if it's a maximum efficient contract. And a lot of people call a MEC a modified endowment contract. That's what the government calls it. I call funding a life insurance policy up to the dollar that you can fund it to before it becomes a MEC. I call it a maximum efficient contract, because that's NEC, same thing, right? So we want to make it just under a MEC, or we want to make it a maximum efficient contract. And so when you look at this contract, it took me 2 seconds to look through, and she said her whole goal was making this thing a cash value machine with an index universal life. And going through a WFG process, her upline structured her a policy where it was a $200 a month premium, so that's $2,400 a year, but the MEC level on this was $3,700. So that means she's not even funding it close to the maximum efficient level, and there's a lot of extra charges, a lot of extra fees, a lot of inefficiencies that she was paying no matter what. You have to understand how you're reading the illustrations, but once the illustration is made, you have to understand all the moving parts in it. There's a reason that they have the guaranteed and the non-guaranteed. The guaranteed will never hit. That's the only guarantee in the illustration, is that will never perform like it says it will perform. But the other thing is they have some companies actually have a middle column that it's kind of like a more realistic expectation that will base it on a 3% return or a 3.5% return for most people. There's a reason they do that, because a lot of these companies have been getting sued left and right over these challenges. And so what they do is they put that third column in there to insulate themselves, to protect themselves from lawsuits, and say, hey, buyer beware. Don't let the illustration fool you. Go with this. Now they keep it there, to me, which is kind of a scam. They keep it there just kind of allow agents to use it as a sales tactic, but it definitely is not all it's cracked up to be. So anyway, I hope you found value in this. If you have any questions at all, go ahead and engage with me in the comments below. I do my best to respond to every single comment I possibly can. If I see it, I will respond to it. If you haven't already, I would just be honored if you hit that like button. It really helps the channel out. It helps what we're doing. I'm trying to create a lot of content here and just get out there and serve people who are looking to make probably the most important decision of their financial lives. And that is basically the decision of, what do I want to do? Do I want to buy an index universal life policy, or do I want to buy a whole life policy? And I mean, to me, the answer is pretty clean, pretty straightforward, but there's so many marketing guys that are so good at marketing right now that are selling index universal life. There's so many people who are involved in organizations that are selling index universal life, and they just don't know what they don't know. They don't know what they're getting into. And I'm seeing this, and it's just kind of making me scared for the world right now. And so I'm kind of on a mission to educate agents and consumers about what's going on and the different kind of moving parts inside of both of these policies, and different types of policies that they can use, and different things to consider for themselves. I can't sell you anything. I'm not licensed. I'm going to be straight up about that. I run a business development company, but I love, love, love life insurance and what it can do for people. So if you're interested in that topic, hit that subscribe button, hit the bell, that way you get notified every single time I launch a new video. It's late here where I am, so bear with me. It's like almost midnight and I'm filming this video because that's how obsessed I am with this stuff. So anyway, I hope to see you on the next video. I hope you have a blessed, inspirational day, and we'll talk to you soon. See ya.